Hello and welcome to this Carbon Tracker video. This time around, we look at Carbon Tracker's Global Registry of Fossil Fuels and the new Reserves and Resource Framework, which addresses the critical need for transparent assessment of newly discovered oil and gas reserves. I'm Piotr, part of the Communications and Events team here at Carbon Tracker. If you'd like to download and access the supporting content, then you can click on the QR code available on screen. And remember, whilst you're here, to subscribe to our YouTube channel and click that bell so you never miss any of our latest releases and uploads. And you can join in the conversation by leaving a comment below. We very much appreciate all and every perspective. This video is broken down as follows. 25 minutes of presentation focusing on what the global registration of fossil fuels is about, followed by a 30 to 35-minute Q&A involving expert and technical analysis. Who is Carbon Tracker? Carbon Tracker is a non-for-profit financial think tank with a vision of a fully decarbonised global economy well before 2050. The Global Registry, by comparison, is the first open-source database of oil, gas, and coal production and reserves globally expressed in CO2 equivalent. By increasing the transparency of fossil fuel production, the registry aims to improve the understanding of extraction impacts on the remaining carbon budget and ultimately inform different decision-making processes. All of our research at Carbon Tracker converts climate science into financial risk and reward, with the aim to accelerate the energy transition away from fossil fuels by mobilizing the financial markets. All of our work here at Carbon Tracker, including this report, is free to access and download from our website, carbontracker.org, and also at the fossilfuelregistry.org. Involved in this conversation were the following speakers. Richard Folland, Head of Policy and Engagement here at Carbon Tracker. He was in conversation with Johnny West, Architect of the Global Registry of Fossil Fuels. Subsequently, they were joined by Mina Rejmi, who moderated the Q&A and discussion, and she is a Programme Manager here at CTI, and also Robert Chouette, the Executive Director of the US team of Carbon Tracker. But with that, hope you enjoy the video and pass you on to Richard Folland.
And thank you very much for joining us. So, I'm going to take just a few minutes to provide the context of what we're proposing before I'm going to hand you over to Johnny, who's going to talk you through the envisaged new reserves and resources reporting framework. So I want to say something about the problem, which was the spur to establish the Global Registry of Fossil Fuels, which provides the platform for this transparency and accountability framework. Then I'm briefly going to cover the Global Registry itself. So this slide here, this depicts starkly the problem, which we have 7 times the amount of fossil fuel reserves and fits comfortably within the IPCC 1.5 degrees C budget, carbon budget. To note here that this chart only shows the reserves, which are defined as being capable of being produced under reasonable economic assumptions, and that the resource base is far greater, and that exploration production efforts continue to convert these reserves, quote unquote, into, these resources, quote unquote, into reserves, quote unquote. And that these future reserves won't come from just new developments. And in fact, the bulk of them will come from existing producing fields. Now, that's obviously not good, to put it mildly, for the carbon budget, which is dwindling rapidly, as I'm sure many of you know. And the context here is that rate of decline is about 440 gigatons per annum, which would mean us running out of the budget by the end of this decade. If we can move to the next slide, please. So this and the highlighting of the carbon budget that I just set out in the previous slide, this takes us on to the Global Registry. Its function and purpose are set out there, and I wanted to emphasize 3 points. First, the forward-looking function of the registry, expressing estimates of oil, gas, and coal production and reserves in CO2 equivalent. So here that the data can be directly applied to the carbon budget. Second, the global registry is open source, so it's not the same as the data, the information that is provided by the private service providers such as Wood Mackenzie and Rystad, who would charge you a considerable amount of money for that. And finally, and this is important to emphasize, that the global registry is policy neutral, but that it can be very much used as a transparency and accountability tool for government and corporate production reserves. So since the launch of the registry in September 2022, we've been concentrating on improving the coverage and the quality of the data in the registry. We've been working with a variety of stakeholders, governments, investors, and others on end usage. And I should say here that the registry has international support from a number of governments, primarily European, France and Germany, to give you examples there. It has support from UNEP, the UN Environmental Protection Agency, and that's important, with UNEP being the sponsor of the Production Gap Report. And to give you one tangible live example of end use, we are working with the Extractive Industries Transparency Initiative, EITI, on their greenhouse gas emissions reporting pilot as part of the new reporting standards that they're introducing. Now, my colleague Johnny is leading our work on the EITI standards. So at this point, I think that's appropriate for me to hand over to him, and he's going to take you through the new reserves and resources reporting network. Yeah, so over to you, Johnny.
Great, thanks, Richard. Let's just jump in. So this question of new reserves and resources, redefining the way that oil and gas reserves are calculated, which have been an immensely important metric for nearly a century. The current system was essentially set up in the 1930s. Is critical in terms of, as Richard said, the remaining carbon budget. So we need to start off by looking at the positioning of exploration within the industry as a whole. So here you see projections just in one province, which is, the Gulf of Mexico. But the three colored areas there correspond to what overall volumes of fossil fuels and, therefore emissions would be produced. And it's the respective sizes of those different areas would differ from one region to another, but the schema is universal. Like right in on the left, you've got producing fields. That is what is, pumping out a billion tons a week, together with coal at the moment, just from these producing fields. And then on top of that, you have fields which have been discovered and proved up as reserves in a very lengthy process involving lots of evaluation of commercial criteria, market price, engineering, and so on. And those are all projects in the pipeline, so to speak. And then out beyond that, as you can see, this consultancy has predicted for the Gulf of Mexico, and this has been the history of the oil industry up until this time. You project out a further body of oil that you haven't yet found, as in future exploration. So, excuse me, the idea of the new reserves and resources metric is to be able to take out of company and regulator statistics numbers which correspond to this outside layer. I mean, you might think of these as successive layers of the onion. We have next slide, please. Yeah, so the discovered reserves, as you saw in the earlier graph, are already many times the available carbon budget. And indeed, that graphic is already old because the carbon budget to hit 1.5 is now under 300 gigatons. So the question of how to manage the decline of fossil fuels, these different areas kind of fall into different categories. They're all barrels of oil, but they have very different stages of development, of commercial relationships, and you know, provability and so on. So our contention is that the yet to be found oil reserves are the first piece of the picture that needs to be reduced and eliminated. And then you move successively through managing the decline of projects in the second area which have been discovered but not yet fully developed into production. And then finally, there will be a need to manage decline of fields which are now in operation to get to net zero, which envisages an overall cut in production from current levels of over 75%. So these are really differing degrees of difficulty as well in relation to existing contracts and arrangements and interests and ways of doing business. And so to address the exploration component is first in the sequence. Next slide, please. It's important to just a quick word really about all of the different technical language around reserves and resources. It's important to understand that there are many, many different numbers existing for the same field or the same country at the same time, because they correspond to different categories of certainty. So the first chart that we saw, which had the amount of fossil fuels already at a multiple of the remaining carbon budget, actually corresponds to the smallest oval in this chart, to proved reserves. The concepts are common worldwide. There's a lack of data and a lack of a clarity about whether these standards are being rigorously applied in every field in every country in the world, but those are not material levels of doubt. So from proven reserves, you go out to a larger body of oil and gas which has been discovered, but there are remaining questions around, you know, how much money it takes to develop it versus what markets that field will have access to versus what predictions of future market price and so on. And then you go further out, and these are lower degrees of confidence, but these are still categories of oil and gas that have been physically located, where the economic analysis hasn't yet been done. It's simply the geological analysis has been done, and perhaps some engineering concept for how to develop an infrastructure. And then farthest out, you have more probabilistic guesses of the total amount of oil and gas in place, which is bigger than all of that alone. So once again, the smallest oval here corresponds to the bar chart you saw in the beginning, which is already multiple times. If you could have the next slide, please. Oh, I just basically explained that. So let's go to the next slide. Can we flip the slide? Hello. Ah, good. Thank you. One back. So as the transition continues, we see the exploration issue coming up. The IEA actually, some time ago now in 2021, in their first publication of net zero, said that they saw no need for new oil and gas fields. The last COP in Abu Dhabi started to talk about what phasing down. There was a debate about phasing down versus phasing out, but everyone's agreed at least on phasing down. And given that the amount of discovered reserves and resources are already far too big to be able to be produced against the carbon budget, there really should be zero new exploration in order to get to net zero. But the industry broadly continues in the way that it always has, and new reserves are important for companies, and this is after all a business, because the reserves replacement factor still counts in the valuations of companies in the stock market, and that relates to the way reserves are traditionally calculated, which is what is the total amount of booked barrels or cubic meters of gas which a company has access to and can produce as an indication of future revenue, really a metric developed to serve the shareholders of those companies. And in that net reserves balance, you're simply looking at, the start of the year, what was the total amount of those reserves January the 1st? What is the total amount December 31st? Has it gone up or down? Multiple factors have pulled those reserve numbers, some factors up and some factors down in between. But with the net reserve balance, you simply get a start figure and an end figure, the total being the amount of fossil fuels a company still has access to produce in the future, with no direct and explicit consideration of the carbon budget. Next slide, please. So our suggestion then is that the portion of reserves and resources which are being added freshly should be split out and available as a separate metric. This is a subset of existing reserves information. So this isn't, in fact, a proposal to assess reserves differently. It's a proposal to publish that subset of reserves information which already very broadly exists amongst companies and amongst governments, in order to identify the amount of new exploration, how many barrels and cubic meters it's producing and their associated emissions. And once that is available, we're then able to see what the global picture is, how much is being added to the pile as we see the carbon budget diminishing year by year. Next slide, please. Here's an example of why we'll run through 2 or 3 examples of why the net reserves balance approach it isn't helpful in terms of the energy transition. It serves all kinds of other functions, but it's not fit for energy transition. If you take here are the net reserves balances of 4 oil majors: Exxon, BP, Shell, and Total Energies, and their collective reserves were 80 billion barrels at the start of 2020 and 55 billion barrels at the end of 2023. So the net reserves went down 25 billion barrels. If those are the only numbers you see, you might then assume, because those figures are falling, that something is happening in alignment with Paris, in alignment with the various kind of emerging policies and the agenda of net zero. But in fact, in that time, those same companies have added 11 billion BOE, barrels, it's a measure which covers both oil and gas, in their reserves by new exploration, whether that is, as Richard mentioned, in greenfield projects or as in brownfield projects. And I do want to stress this greenfield brownfield question, because the new reserves and resources metric applies to all new exploration in whatever kind of field. And a lot of the consideration of the exploration issue has been dealing simply with how many new licenses and new fields. But we have a lot of data to show, for example, in the Gulf of Mexico, of about 40 billion barrels which were added over the last 50 years. 25 billion of them, so over 60%, were new discoveries in existing fields. So an examination of exploration which only looks at green fields is going to miss the big picture of what the real state of emissions is. So there you have net reserves down 25 billion barrels at the same time as 11 billion barrels were added, new barrels. Next, please. Here, the EIA, the Energy Information Administration, which is an arm of the federal government of the United States, has published these subsets of information. And without going too much into the detail, if you look at the top chart here, you see all of these categories taking you from a start to an end. And then you've got, as I described, various things which are taking the total amount of reserves up or down. So adjustments, which is some kind of technical reevaluation and revisions. Then there are companies are buying and selling assets all the time to each other. Then they are discovering, you're making new discoveries, and then they are producing, which of course reduces their net reserves balance, and you arrive in the end at the total on the right. But so here we have an example with the growth of the shale revolution and the turnaround in America since 2005, to the point where it's now a major net not net, it's a major exporter, where the net reserves balance does show you know, an increase, a doubling, in fact, roughly 22 billion to 44 billion in reserves. But because production went up so much again, the real figure for the total amount that was discovered was 54 billion. So both net reserves balance and new reserves were moving positive, but new reserves were twice as much as was indicated in the net reserves figure. And if we can have next slide, please. And then here we have some data from Norway, which is constructed slightly differently. So what we've done here is to build this metric as close to standardized as we could from the data available. Our whole contention and proposition being that a slight adjustment in the way that the current reserves data were published would enable standardization around the new reserves metric globally. So in Norway, we don't have the same subcategories of reserves published, which has allowed us, in the case of the majors and the USA, to do that waterfall. Instead, we have different data relating to categories of reserves and then what are called contingent resources. There's plenty more detail on this in the paper, but I don't propose to go into that now. But the big picture is another mismatch, essentially, between what you would imagine by looking at the net reserve balance in Norway from 2010 to 20, which saw a decline of 2.5 billion barrels, but at the same time as over 10 billion new barrels of BOE, barrels of oil equivalent, were added. So we see very broadly, whether company reporting or government reporting, that the net reserves balance behaves in very different ways because it's responsive to a lot more factors than just the new reserves and reporting. It's responsive to market price. You know, net reserves balances collapsed a lot without anything physical happening in the real world at all in 2020, simply because of the coronavirus depressing prices. And since one of the criteria to write in proven reserves is their commercial producibility, once the price was so low, a lot of existing reserves were written down, so to speak. That's a paper operation, a financial operation, which is not a reflection, you know, no single piece of engineering and no wells were drilled either way in that change and many other changes. Whereas new reserves and reporting is simply about the physical expansion through drilling, exploration wells, appraisal wells, extensions of existing fields. It is the continued engineering of greater access to fossil fuels at a time when the carbon budget cannot sustain it. Next slide, please. So I mean, it's perhaps surprising. It was surprising to us when we looked into it. You cannot find a reliable figure in public domain for how much oil and gas was added by exploration last year. Companies do standardly accumulate all of these subcategories, and of course they know what exploration they've done and what proportion of their reserves have been added by fresh exploration in any given year. We think it's strongly probable that they forward those subcategories of information to governments in nearly all cases. We can't be certain because by the nature of it, there's a lack of transparency. So all we can see is places here and there where there's a complete data set which allows us to build this metric, and many, many other places where there isn't. But given our understanding of the relationships between companies and governments, it seems highly unlikely that the governments don't have that information and could publish it, or if they don't have it now, could simply ask the companies for this data, which already exists. But we're in a situation now where the carbon budget is under 300, perhaps approaching 250 gigatons, and there is no figure in the world in public domain to say how much oil and gas was added last year and what the estimate of the emissions embedded in those new reserves is for last year. Broadly speaking, the range of uncertainty theoretically is as wide as between 20 and 45 billion tons of CO2 equivalent. And I say that's a very broad theoretical range, which simply relates to how much we think reserves have covered the production which reduced the reserves base at the start of the year. With net reserves figures, you can't tell that. The lower range assumes that hardly any of existing production was covered. The upper range assumes that virtually all of it was, but we can't prove it. Now, it's possible to produce some kind of reasonable expert evaluation, which would say, well, maybe it's about 25 to 30 billion tons based on our understanding of what Russia did here and Saudi Arabia there and the pre-salt in Brazil and so on. Experts could go into long studies and produce that kind of evaluation figure, but we're suggesting it should be a lot simpler than that. We should simply be able to see that number globally and by country and by company. So this is the metric we refer to as new reserves and resources. If I can have the next slide, please. Those first 2 points I think we've covered. The question of driving new reserves and resources to zero, as I said, IEA's conception of net zero, which is the leading conception of net zero. I mean, there are a number of other net zero scenarios or near net zero scenarios under IPCC that have been submitted into the to the database there, but all of them have a rapid decline of overall production, which argues for an even more rapid decline of exploration. There are side arguments here and there, often made by people involved in the industry, as to how overall managed decline doesn't mean that this company in this place should stop producing or even exploring. But of course, the sum of all of those exception case arguments is business as usual and flying off from net zero or any kind of controllable limit to temperature rises. So once you create a net reserves and resources metric, the idea is to track it and to ensure that it's driven to zero as soon as possible in any given scope. You could imagine activist shareholders in a company putting down a deadline target for when that company would achieve zero new reserves and resources, or that becoming a policy discussion in a country. And of course, globally, you would need a zero figure for new reserves and resources as well. Next slide, please. Oh, well, that's I think that's it then. So I'm happy to take questions. Rob, do you have anything to add?
No, just coming back on camera. Thank you, Johnny, Richard, and Hannah. We'll move to questions now. If you have any questions, please feel free to drop them in the chat, and we'll go ahead and start. Okay, we have one question from Randolph. He said, how do we stop countries from using reserves that push the world over 1.5 target?
I don't know is the short answer to that.
I can come in on that to some extent,
Yes.
John, but do you want to go first?
Well, only to say that the new reserves and resources metric, as the broader work of the registry, as Richard said, is designed to provide information to guide policy. It isn't a policy itself. These are technical tools. Richard.
Yeah, thanks, Johnny. Well, as we've talked about or emphasized in terms of the registry, and this is where we see the new framework that Johnny's been talking through would really strengthen this, is that this data being published in the first place is about generating greater transparency, but really the primary objective here is greater accountability, both at the government level on production reserves, but also at the corporate level as well. So going back to that question there, how do we stop? How do we collectively, I guess, is your question, stop countries using reserves to go over 1.5 degrees? Well, there's a couple of thoughts that I have. I would go back to the global stocktake text that was agreed at COP28 in Dubai last December, which had in there that language about transitioning away from fossil fuels. And this was important because that's the first time really that a COP text has singled out the essential need to address fossil fuels within the context of the Paris goals, because previously, as many of you know, I'm sure, the Paris Climate Agreement did not mention fossil fuels. So greater accountability there, linking to the global stocktake text, but also an opportunity, I think. I mean, one of the primary objectives coming out of Dubai and in the whole road over the next sort of 18 months to 2 years of the international UN process on climate is the next round of NDCs, of national emissions reductions targets. There is a good dialogue, discussion going on about how to improve NDCs, not only in terms of their ambition, but also the quality. What should be included in NDCs? And I think you know one could make the very legitimate argument that in terms of addressing the transition, that we need greater transparency and accountability in government NDCs about what are their production plans and how are they going to match up compared with impact on the carbon budget. Anyway, I'll stop there and hope that's helpful.
Okay, the next question's from Alistar. Do any countries other than the US currently disclose the NRR? And do private data providers such as WoodMac or Rystad have these numbers?
So on countries, there are a couple of others, Colombia, Mexico, and 1, 2, or possibly 3 others that escape me at the moment, not any of the major producing countries. I'm sorry, I've completely forgotten the second question. Sorry, could you repeat it? Yeah.
It's do the private data providers have this information?
We haven't looked exhaustively, but we haven't found it readily, I think would be the best way to describe it. They provide the normal categories of resources in terms of 1P, 2P, proved and probable, and so on, and sometimes contingent resources. Those are essentially static. You don't know when you see that number how much of that came in when. And I'm not a super frequent user of those services. I am an occasional user, and I've looked at them, and we haven't found it.
Okay, next question is from Moses. Why do you think that countries are not providing new information?
It's hard to say. You know, these are industries which have been going for decades, and they've got very set ways of doing business. You know, the way regulators relate to companies has also been kind of settled in. And although, of course, everyone knows the transition is coming, you know, these are a set of working relations which broadly function, and in terms of, you know, doing business, you know, which has been the kind of main point up until now. And so whatever ways were established in the beginning have largely continued. You know, people argue about how much of this is due to secrecy, and it's certainly true that often there's a confidentiality argument which is cited. In my experience, confidentiality arguments are usually cited without any substantiation. In other words, someone just assumes something must be confidential and says it as the reason to kind of close the discussion without it necessarily being true. And I think you can see that if you look at the United States. I mean, the United States is the most competitive oil and gas production market in the world by an order of magnitude. There are thousands and thousands of companies, and that date and it's managed, I think, Rob will correct me if I err, but it's mostly managed at the state level, and yet we're seeing this data has been collected by a federal agency, which means that the data would have passed from the companies through to state authorities, and then from state authorities up to the federal government that has then compiled them in these figures. They do also exist for each of the individual producing states: Texas, Alaska, California, and so on. But you know, it's a pretty conclusive proof that confidentiality is not a major obstacle if these data sets can be published in the United States.
And Johnny, just to add, I mean, you are dealing with a number of government regulators here, aren't you? Have the data,
Yes.
And you know, some, as you say, will cite the commercial confidentiality argument, but others won't. So if others are happy enough to publish, why aren't some of those others who might choose to hide behind the?
I do actually think a lot of it is inertia. I mean, like in the North Sea, there are data sets that the Norwegian government provides, you know, from one bit of water that the North Sea Transition Authority and another bit of water, you know, 200 meters away across the invisible line of the maritime boundary, doesn't report, and, you know, sometimes, you know, gives long reasons as to why it can't report it. And yet it's reported from the other side in industries that have an overall kind of look and feel which is similar in terms of governance structures and the kinds of companies and operations involved. And in fact, some of those are shared fields. So I think it's just, there's a huge amount of inertia. I mean, there may be some active resistance, but I think there's a huge amount of inertia.
But then the pressure through accountability can be applied there to help to shift that inertia. Yeah, I mean, that's
absolutely.
Yeah, and that's your point about the global registry as a public policy tool. Yeah.
Okay, thank you. And then another question from Moses. Do you think the data for Norway would be different if extrapolated beyond 2020?
I can't answer that because I haven't looked at the data for, I mean, I can't answer that. So, I mean, what I know is that, you know, there is the Johan Sverdrup field in Norway, which has come online from memory, 2019 or 20, and his production has ratcheted up in a very big way. But no, I couldn't really answer with any great conviction.
And then we have another question from James. Should production in poor countries take priority over that in wealthy countries? The latter have enjoyed the benefits of consumption and primarily culpable for the problem/costs of both adaptation and mitigations.
It's a very good question, but it's not really relevant to this metric. I mean, the idea of this metric is to provide information on which that discussion can be held. And, I guess I would have an opinion about that in a different context, but it's actually important for the integrity of the metric and for the global registry as a whole that there is, a separation is made between the data which informs that discussion and what position one would take in that discussion.
And it's a justice and equity question, basically, isn't it? Within the context of the whole transition, and of course, there are live discussions around that as well. But yeah, as you say, Johnny, hard to apply this metric in that context. Other than, again, I think the point that we would emphasise, whether it's the global registry or the reporting framework, it's there to be used by a variety of stakeholders, to be able to maybe, apply within the different contexts, including in the multilateral discussions.
Okay, thank you. Next question is from Sinan. How would the rising price of fossil fuels be factored into the global registry of reserves? Would reserves increase or decrease as supply is reduced in coming years? Is this assuming that demand will be reduced?
That is a very good and very difficult question to answer, because if we assume that let me distinguish first between the registry and the new reserves and resources metric. Give the simple answer. There's a simple answer and a complicated answer. The simple answer around the new reserves and resources metric is it's quite predictable how rising prices would affect physical exploration. Historically, it has encouraged exploration because obviously if oil is at $120 a barrel, lots of people decide now's the time to go and look for that oil which we think is out there, but it wasn't worth us looking for when oil was $20 a barrel. The complexity comes in how that traditional cycle reacts then to the energy transition, and if that becomes irrevocable over some kind of agreed time span, which the question suggests, because it's suggesting that price goes up because supply goes down, which would only happen in a kind of net zero oriented situation, then that traditional relationship between a rise of prices and greater exploration would be broken. It would be hard to predict exactly what takes its place. But remember, that only refers to the new reserves and metrics. How fundamentally the overall system of reserves classification needs to be revised so that this could be integrated. What we would like to see is that this becomes an explicit subcategory for publication integrated into the main PRMS system of reserves. And the good news is that SPE, the Society of Petroleum Engineers, is currently started work on revising that standard, and there is a period of public comment available at the moment going until the end of June. So, I mean, going back to the question, the how reserves figures as a whole, that net reserves balance thing I was talking about, the much broader picture, how that would react in those situations, it's really hard to say as it's currently configured, and that's why there's really an urgent need to revise the classifications systems, across the board.
And then, Nina, I can pick up the following question about incentives for producing countries. But Johnny, just before that, looking down, there is a question from Alistair there about whether carbon trackers discuss this concept. You just talking about this with SPE, PRMS folks. So
not yet, but we'd be very keen to.
Right, there we go. So Nina, maybe I'll just this one about, and Johnny, you may well have a view on this, but what incentives exist for producing countries to participate in this kind of transparent reporting from Darius? Well, Darius, I think this is the other side of the coin of the question put earlier about developing countries and bringing in that sort of justice and equity dimension. That one could say here, what incentives are there? Well, particularly in the developed world, one could say leadership. the opportunity there, thinking about fossil producers who can link, again, greater transparency in this area and so on, and accountability with the leadership that hopefully they are providing on climate and reducing their emissions. So that's the basic point I would make. But Johnny,
I don't have anything to add.
Yeah.
Okay, we have another question from Alistar. It's how can competition between producing countries be managed? NDC is on consumption, not production. There needs to be some sort of global agreement process.
There does indeed. Again, I mean, it's not something that these reserves metrics directly address, but I would suggest that that if you were to have such a supply side agreement, it would absolutely need these numbers to be available, and they would need to be available in public domain. I mean, I refer back to Richard's point earlier about these numbers, the new reserves and resources metrics, we haven't seen any sign of them within the commercial services, but even if we did, you're talking about any transformational climate policy involves, very, very big decisions, usually by multiple players, including governments and companies which are public facing because they're listed on stock exchanges and so on. So none of those transformational level agreements, whether like the kind of supply side agreement that Alice is suggesting, we don't think they're sustainable on the basis of data that only some people might have access to with a $30,000 a year subscription behind some firewall, because it's not even only the principal parties in those kinds of agreements which would need to have access to reliable data. Any agreements would have to be sold to publics, to shareholders, to everybody else. And that's why the data that underlies it has to be an open source. So even if those information services did have these kinds of numbers, it wouldn't serve nearly the same function. But I mean,
yeah.
Sorry.
No, and to add, Alistair, well, I'd refer you to the supply side, the international initiatives. Whether you specifically asked about the need to be a new global agreement. Well, there's a fossil fuel non-proliferation treaty, which is proposing precisely that, basically, to complement the Paris Agreement, and then the government backed supply side diplomatic initiatives. I'm thinking about the Beyond Oil and Gas Alliance, which is there about countries exiting from oil and gas production, and the Powering Past Coal Alliance, which is on coal. So there are initiatives out there internationally to address the challenge that you're talking about. Whether these can come together, with Paris, or to complement and to help to sort of accelerate that transition away from fossil fuels, we'll have to see. But clearly that transition is needed.
I would add also, in terms of incentives, a big part of this picture are the national oil companies, not just the kind of super major Western companies, but Saudi Aramco, Rosneft, Petrobras, dozens and dozens of them, who over the last 2 generations have taken over the vast majority of oil production and access to reserves. And in that context, many of them are in very different kind of business situations to the Western majors or the super majors. However much their production is, their cash flows might be challenged for various reasons, either because they have to hand it all over to the government because the national oil company is the cash cow for the government, or because it's many of these, like Pemex has commercial debt of over $100 billion. Many of them are very, very highly leveraged, which means that their cash flow they make from current operations gets sucked into repaying debt and all the rest of it. And in that context, I mean, it all sounds very technical, but in that context, those companies need to consider, the capital intensivity of new exploration against the timeline of possible production that would result from any new exploration, against also the energy transition. And they are companies, unlike super majors, especially as a result of the last 2 or 3 years, which are very cash rich. There's a big variation in the NOCs, but many of them are not necessarily cash rich. And so those capital investments required for them to make new investments is a very critical issue, and an issue which doesn't, which the governments who own them and nominally control the broad lines of their operations may not be aware of, and the publics in those countries may not be aware of. So we see a particularly high usefulness for these kinds of metrics in countries where the industries are being, where the major players are NOCs.
Johnny, there's also, just wanted to flag on this question, Arturo from New York Community Trust has also highlighted the proposed World Commission on fossil fuel phase out as well. And that's a good point, Arturo. But also, Arturo did ask a question earlier, and this was about challenging the prevailing approach to valuation. So maybe just thought it's worth picking that up as well, Johnny.
Yes, well, so I guess that's the context in which it's interesting that the SPE are revising the standard again. It's not so long since the last revision, 2018, so I don't know the background to that, what's prompted that, or if it's purely periodic or whatever. But there are. Of course, there are all kinds of questions of scope and so many issues related to all of the various outcomes and impacts from oil and gas production. Some of them are harder to measure and a lot more diffuse than others. They're very real, but very, very hard to measure. Others, such as this, I mean, this is crystal clear. This is, people, they drilled some wells and they found this much new oil, and then other aspects to reserves. A revision of reserves classifications could be things like, what are the amount of embedded emissions in reserves should be a figure integral to the reserves themselves, because there's a carbon price. It's not universal, and it differs in value from one country to another, and is very, very irregular. So we're in a situation today where the language of how to build reserves classifications suggests that these are factors which should be taken into consideration, but in a very loose way. And perhaps it's time to say that to split out these and some other elements, such as decommissioning obligations, things which can lend themselves to very precise numbers, measurements, and quantifications, and at least make sure that those get integrated into an updated way of classifying reserves.
Sorry, Nina, I interrupted your flow, but just wanted
No worries.
Yeah.
So I have another question from Gregory. He said, can you expand this work into a verified global registry of carbon credits?
We have no plans to get into carbon credits, which is, we simply seeking to address one piece of the puzzle, and it's enough of an effort to be trying to do that. I mean, I obviously understand there's huge uncertainties around carbon credits, and it's massively complex and increasingly important if Article 6 trading between countries ever takes off, and the crisis of validity in ESG reporting more broadly. But I know is the short answer. When we have no plans to go into carbon credits.
Okay, I have another question from Jens. Why is this business on exploring new oil reserves of Exxon, Shell, BP financed by the finance industry in contradiction to handle the climate crisis?
It's a good question, but I couldn't give you an answer. But we do think on the question of financing, and a lot of interest in this and other metrics related to the transition. We find a sharp distinction, I think it would be fair to say, between the attitude of operating companies and investors. You know, it's like the, I forget the analogy, but, you know, the turkey and the egg, or one of them's interested, the other one's committed. The investment community of all kinds is highly interested in these kinds of metrics and getting better metrics. And obviously can either choose to invest or not invest in those sectors. They could just go to a different sector. As to why financing happens now, I mean, that's just a bigger subject, I think, than we've got space for.
Okay, I have a question from Randolph. He says, I guess your role is raising awareness, action is somewhere else. IISD has set out a 5-step plan. Who coordinates efforts?
Let me jump in on that one, Nina. I mean, it is more, I mean, you're absolutely right, Randolph. We're putting the data out there, so that is about raising awareness. But you know, I would make the additional point that we talked about earlier, that end usage by the range of stakeholders, whether we're talking about governments, whether we're talking about investors, whether we're talking about civil society organizations. So it is more than about raising awareness. We really would like this data to be used in an active sense by that range. I mean, there you are. You've identified another research organization clearly working in this area, and we know IISD well. To your question about who coordinates, well, you know, whether it's a range of research organizations or civil society organizations, your different type of stakeholders working together more on this, I think one could argue some of that is going on already, which is actually to help to sort of generate the greater transparency and accountability around this.
If I could just add, I'd agree with Richard. It's beyond raising awareness, because I mean, everything the registry does is actually designed to enable mechanisms. And, you know, some of them relate to mechanisms which don't necessarily exist at all. So, you know, the USA and the European Union have both in the past couple of years introduced regulation around methane emissions, but the basis of calculation of those numbers has not been driven to an empirical basis. And so there's a lot of policy being made blind, and actually a lot of market instruments being made blind. Well, when I say blind, I mean on the basis of projections whose validity has never been completely validated. So producing these kinds of numbers, for example, it makes it possible for a policymaker or a company to conceive of a zero new reserves policy. Without the numbers, you may not even be aware of the difference between net reserves and new reserves and resources. And once you are, you can use those numbers as you like. But the idea is not just public awareness in the sense of media or particular campaigns, but we'd like to see this data or this approach embedded in commercial agreements, embedded in primary and secondary regulation. That's the goal.
Absolutely.